Okay, now let's talk about the concept of the efficient frontier. The efficient frontier represents the set of portfolios that will give the highest return at each level of risk, or the lowest risk for each level of return. So let me illustrate this by example. Let's say that you as an investor want a expected return of 15%, and then you create all possible, or identify lots of possible portfolios which give you a expected return of 15%. So let's say that you identify portfolio A, B, C, D, E and so on, all that give you an expected return of 15%. But the difference between these portfolios is that they all have a different level of risk. Now, which portfolio do you think you will like the most, or which is the most efficient? The portfolio that is the most efficient here is portfolio A, because at an expected return of 15%, portfolio A has the lowest level of risk. So this then is your preferred portfolio. Now, what if your expected return is 14%? Then let's say that you have these portfolios. Here your preferred portfolio is going to be this one, because it gives you, let's say this is X, this gives you the lowest risk at a expected return of 14%. Do this for various levels of return, and essentially you start plotting something that will look like this. So this line or this curve is referred to as the Markowitz efficient frontier, and what that is saying is essentially that the Markowitz frontier, given that you can only invest in risky assets, then this frontier represents the portfolios that give you a certain level of return at the lowest possible risk. So that's one way of putting it. The other way of putting it is that for a certain level of risk, let's say that this represents 20% risk, at a certain level of risk, this frontier, Markowitz's efficient frontier, shows you the highest return that you can get at a particular level of risk. So this then is your efficient frontier. Remember that a constraint with the efficient frontier is that you are only allowed to deal with risky assets. Now we are going to remove the constraint of risky assets, and let's say that you can also invest in risk-free assets. So in Pakistan, let's say that we can invest in T-bills, and the return here in Pakistan is about 13% on T-bills. What's the standard deviation or the riskiness? That is 0, because if you invest in a T-bill, you know you are going to get 13%. On my expected return versus risk graph, this will be about this point over here, return of 13% and riskiness of 0. So if we have this number over this point over here, we can create what is called the CML, or capital, actually we'll call it the CAL, or capital allocation line. So the capital allocation line, I'll first tell you what it is and then give a more detailed explanation. We start from the risk-free rate and we figure out where this tangentially touches the efficient frontier. So starting from the risk-free rate, and the line that starts from here and just touches as a tangent the efficient frontier, this is called the capital allocation line. So the capital allocation line in a sense becomes your new efficient frontier. So what does that mean? let's just call this point where the cal intersects, or where the cal tangentially touches the Markowitz efficient frontier, let's call this the point M, or let's call this the market portfolio. So if that is the market portfolio and this is the risk-free portfolio, or your T-bills, then we essentially have two assets. So this market portfolio, let's collectively lump this together and call it one asset. So what are our two assets? Our two assets are our risk-free T-bills and our market portfolio. And the capital allocation line now represents a combination of these two assets. Let's call this point T. Point T represents a 100% investment in T-bills and a 0% investment in the market portfolio. So as you would expect, the risk is 0 and the expected return is 13%. Point M represents 100% of your investment in the market portfolio. Let's say that your riskiness of the market is equal to 30%. And let's say that the expected return of the market is, let's say, 17%. So if you do 100% in the market, you have an expected return of 17% and a riskiness of 30%. Points in between, so along this line, represent a different weightage of T and M. So let's say some point, let's just call this point Z. So point Z over here, let's say that this point Z has 50%. So for point Z, we have 0.5 in percent of our, or 0.5 or half of our portfolio in T-bills and half in the market return. So what is the expected return of this portfolio where we have 50% in T-bills and 50% in the market? This would simply be equal to 0.5 multiplied by the expected return of the market multiplied by 0.5 into the 0.5 into the expected return on T-bills multiplied by plus 0.5 into the expected return on the market, which in my example is 17%. So you can come up with the expected return on the portfolio. Now how do we come up with the riskiness of the portfolio? Here we use the formula that we saw on the earlier page. So the riskiness of any portfolio along the capital allocation line will be given by this formula that you have seen before. Now notice what happens to this formula. What's the correlation between the market portfolio and the risk-free asset? That correlation is 0. Why? Because no matter what happens to the market, your return on T-bills or your risk-free asset is 13%. So since these two returns are independent of each other, the correlation is 0 and hence this term cancels out. Now let's say W2 represents the weightage of our risk-free asset and sigma 2 represents the riskiness of our risk-free asset, which is 0. So this cancels out too. So our sigma for any portfolio along the capital allocation line simply becomes equal to W1 sigma 1. Now remember, W1 was the weightage of our market. So W1 is the weightage of the market portfolio in our overall portfolio. So remember we said T and M. So if the weightage is 50% in T-bills, 50% in the market, then the standard deviation or the riskiness of any portfolio along the cal is simply equal to the weightage of the market portfolio times the standard deviation of the market portfolio. So if the weightage is 0.5, then for a portfolio with a 50% weightage in the market portfolio, the standard deviation will simply be equal to 0.5 times the standard deviation of the market. So this is an extremely important point. The other important point that I will repeat is that the capital allocation line now represents the highest expected return for a given level of risk, assuming that you can invest both in risky and risk-free assets. At this stage, I'll also just help you derive the equation for the capital asset line, and we are going to use this basic format of y is equal to mx plus c, where m is the slope of the line, c is the intercept on the y-axis, y represents expected return, and x is represented by the riskiness. So under that y, we now have the expected return of a portfolio is equal to mx. What's m? M is the slope. Remember, the slope of this line is change in y over change in x. What is the change in y? It's the expected return on the market minus the risk-free rate. What's the change in x? It's the riskiness of the market. So your gradient is the expected return on the market minus the risk-free rate divided by the riskiness of the market. The x variable is the riskiness of the portfolio, and the intercept on the y-axis is the risk-free rate. So pause here for a minute and make sure that you understand this equation. So you need to understand this and memorize it. This is the equation for the capital allocation line. Okay, so we've talked about the capital allocation line and the efficient frontier. So that was from the perspective of the market and the portfolio. Now let's talk about the perspective of an investor. Different investors will have different degrees of risk aversion. Risk aversion refers to the behavior of investors of preferring less risk to more risk. So risk averse investors prefer lower to higher risk for a given level of expected return, and they will accept high risk investment only if they are getting a higher expected return. So all this is just different ways of saying the same thing, and you need to be very clear about this concept. Okay, now this material is a little new in the 2011 curriculum, and I think a number of study guides don't do justice to this, especially if you are looking at Schweser. I don't think this material is covered in Schweser very well. But it's in the curriculum and there are questions in the curriculum on this, so I think it will be a good idea to pay close attention here. So risk aversion for different types of investors. Now just to illustrate the point, let's say that we have an investor who is risk neutral. What does that mean? That means that, and this is just a theoretical point, a risk neutral investor is one who does not mind taking risk. So for him, let's say that if he wants an expected return of 16%, then investments that become more and more risky, that doesn't faze him. So as long as he is getting an expected return of 16%, no matter what the risk, he is equally happy. So if he were to get a return of 17%, he would be even happier. If he gets a return of 15%, he will be less happy, and so on. So for a risk neutral investor, his utility curve or indifference curve is represented by horizontal lines. Now let's take another more normal investor who is risk averse. So for a risk averse investor, a utility curve or the indifference curve will look like this, which says that, so this is for risk averse. If the level of riskiness increases, then he needs to get a higher return to keep him equally happy. So this in the curriculum, these are sometimes referred to as indifference curves. They are also referred to as utility curves. So the way you can think of this is, on a given indifference curve, the investor is indifferent. So between point X and point Y, the investor is indifferent. So he's equally happy or equally unhappy, because in going from X to Y, he is getting a higher return, but that return is coming at a higher risk. So what about another investor? Let's say another investor, let's call him investor B, has this sort of a indifference curve. So is investor, so this is for A and this is investor B. Is investor B more risk averse or less risk averse than A? And to answer that question, let's look at it this way. Let's say that for 1 unit of risk represented by, say, this length, notice that investor B only requires this much higher return. So let's say that this is 16.5 and this is 17. So clearly investor A is more risk averse, because to compensate investor A for 1 more unit of risk, we need to give him a much higher return. Investor B is less risk averse, because to compensate him for 1 more unit of risk, we are just giving him a slightly higher return. So the steeper the indifference curve, the more risk averse an investor. Okay, so an investor with this indifference curve will be even more risk averse. Okay, now what about a risk loving investor? Now again, this is a totally this is a somewhat theoretical point, but somebody who loves taking risk. For a risk lover, the utility curve or the indifference curve will be downward sloping, which is saying that as he takes on more risk, he loves taking risks so much that he's willing to live with a lower return. So a compulsive gambler might have this sort of a indifference curve or a utility curve. Now I also need to explain this concept of U is equal to E expected return minus half A into variance, and this formula is the one that is not clearly explained in most study notes, but it's there in the curriculum. So utility U represents a given level of happiness. So let's take this investor B. So for investor B, let's say that for a given level of happiness U is constant, then the relationship between expected return and variance, so let me just write this another way. So I can write this by saying that expected return, so the expected return is equal to half into A into sigma squared plus U. So algebraically I've just readjusted. Now so A represents the level of risk averseness. So level of risk averseness. So the more risk averse an investor, the higher the value of A, and U represents the level of happiness. So with, let's say, U fixed for a minute at 16, then we will plot this curve over here. Look, the sigma is a squared, so that's the x-axis. Actually, this is not variance; it's a standard deviation. So notice that as the risk increases, the expected return will increase parabolically, because the x variable is squared, and the steepness with which this increases depends on the risk averseness. The more risk averse the investor, the more steeply this indifference curve will go up. So for investor A, the risk averseness number will be lower than the risk averseness for B. Now with investor B, if U is now, instead of 16, we increase the level of happiness to 17, then we will simply plot another indifference curve which is above the first one. So let's say this is I1, the first indifference curve, we can call this I2. So the indifference curves for a given investor will always be parallel, so they will never intersect, and the higher we go on these indifference curves, or as we move left and up, that means the investor is happier. On a given indifference curve, he is indifference between any point on a given indifference curve, but if he has a choice, he will always prefer the indifference curve that is higher. So this illustrates the important concept of indifference curves as well as this relationship. Now let's talk about the optimal investor portfolio. So we are going to combine the capital allocation line, which gives us a picture based on the market reality, and we are going to combine that with the indifference curves, which are the curves related to a given investor. So as discussed earlier, we have a capital allocation line which looks like this. This will start at the risk-free rate. Let's just take that at 13%, and then this goes up based on so the slope of this line, as we discussed earlier, depends on the riskiness of the market, the expected return of the market, the risk-free rate. So based on this, based on these numbers in the market, we basically plot the capital allocation line. Now for a given investor, we also want to plot the indifference curves or the utility curves. So let's go back to investor B. So if we plot the utility curves, remember they look something like this. So this is one curve, or let me just call them the indifference curves. I am switching between the two terms because both the curriculum and most study notes interchangeably refer to these curves as either the indifference curves or the utility curves. So for a given investor, remember, we will have these utility curves that are parallel to each other. They will never intersect. So if a given investor has utility curves that look like this, I also mentioned that the investor is happier. So the investor is happier the further up he goes on these utility curves. So the optimal portfolio for an investor would be a portfolio which intersects the capital, or where the indifference curve tangentially touches the capital allocation line. Why? Because let's say that this point A represents the point on a capital allocation line, which means that this portfolio is possible given the market conditions, and this point A also puts the investor on the highest possible indifference curve. Ideally, obviously, the investor might like to be on this higher indifference curve, but there is no portfolio in the world, or at least in his market, that can give him this indifference curve. So we find the point A which puts him on the highest indifference curve, as well as on the list of and this is also on the capital allocation line, which means that this portfolio is possible. So this then portfolio A then becomes the optimal portfolio for our investor, and this then represents the ideal or the riskiness he is taking for that portfolio, and this point is the expected return on the optimal portfolio. So that essentially wraps up this discussion. Notice that what we did was we connected the concept of the capital allocation line, which comes from market-based realities, with the profile of the investor, which is reflected by these different indifference curves. We combine the two concepts and come up with the optimal portfolio for the investor.